Alright, I am just going to pick up right where we left off at since I only have 15 minutes to record each session. We just got done talking about section 1 in the previous video. Now let's jump into section 2. Begin your chapter goal. We want to define accounting terms related to the plant assets, depreciation and property tax expense, while calculating depreciation expense using a few different methods. Okay, so section 2 is kind of the bulk of things where we deal with one of our depreciation methods. So section 2, we want to learn how to use a straight line method to calculate depreciation. Okay, so let's just jump right into it. Using this method, okay. So section 1, we worked with buying an asset, buying property of some sort. Okay, so let's just say we bought a car. We bought a car that was valued at $3,250 worth right here. Estimated salvage value. Okay, what this means is if we bought this car and we have it until it dies, we then bring it to the junkyard. They're still going to pay us some sort of amount for the rest of the car. Okay, so in this example, let's just say that when we take the car to the junkyard at the end of its life, the junkyard still pays us $250 worth. Okay, so what we want to do is take the original amount that we paid for the car, $3,250, subtract $250 from it because that's still how much, when we get rid of it, that's how much it's still worth. Okay, so now $3,000 for how much we are anticipating it to depreciate in its lifespan. Okay, so this is where that $3,000 comes into play. Now that $3,000, we want to bring that down here. So this is our estimated total depreciation. We are planning on having this for 5 years. Okay, so now to find our annual depreciation, we want to take our total depreciation, which is your $3,000, divide that by how many years that we will have this car. Okay, so since we're having it for 5 years, we want to take $3,000 divided by 5. Now we are anticipating our depreciation expense per year to be $600. Okay. Now with that $600, we want to break this down. Okay, because it's not. It doesn't happen all the time where if you buy a car and you keep it for the exact amount of 1 year or 2 years or 3 years. Sometimes you keep it for 2.5 years, or you keep it for 20 months, or you keep it for 39 months. Okay, so now we want to break this number down into the monthly number. Okay, so this is our annual, so we pay $600 per year in depreciation. Now we want to break it down. How much do we pay per month? So all I have to do is take that $600 divided by 12, since there's 12 months in a year. So now we are estimating that we pay $50 a month for this car. Okay, now let's just say it goes bad and we get rid of it at the end of May. We take it to the junkyard. So now our monthly depreciation, since right now we have not covered the full year, the full 12 months. We've only covered part of the year. So we've only covered 5 months out of the year. So if we wanted to determine how much depreciation has already accumulated so far in January, February, March, April, and May, those are 5 months, all we have to do is take our monthly depreciation expense, which is $50 a month. Since we only had the car for 5 months, if we get rid of it here another month, or 2 months, 5 years, we are now projecting that we are going to pay $250 worth of depreciation just for this year. Okay, so this is where the numbers come into play. Okay, this is how much I bought the car for. This is how much the junker will buy it for. Subtract the 2 to get. This is how much the car will actually depreciate. We then bring that number, divide that by how many years we are anticipating having this product. Since it's 5, take 3,000 divided by 5 to get 600. 600 is your annual depreciation expense. That's how much this car will depreciate in 6 months or in 12 months. Now you bring that 600. Now if we end up selling the car midway through the year, okay, or midway 8 months, 9 months, 11 months down the road, okay, so to determine the depreciation per month, 600 divided by 12 equals your 50. Okay, then when you do sell the vehicle, okay, if we do sell at the end of May, we did use the vehicle for 5 months, January, February, March, April, and May. So now take your monthly depreciation, take that times 5. So we still have to account for $250 worth of depreciation in January, February, March, April, and May. Okay, so that's where all these numbers come from. Okay, I know I'm going a little bit fast, but I'm trying to get this all in, and I can also answer questions individually. Okay, so now, once you have your numbers right here for all your depreciation, which is this one as well, this next one is working with accumulated depreciation. Okay, so let's just say that in 1 year it depreciated $1,200 worth. Actually, here, let's back up. Let's just say that your product accumulated a depreciation so far of $1,200, and in this year it already accumulated $600. In order to look for your accumulated depreciation, you just take these two numbers and add them together. So 1,200 plus 600, accumulated depreciation is now 1,800. But I want to walk you guys through the problem first, because a lot of these numbers are going to make sense as I'm walking through this. Okay, let me zoom in for you. I'll come back to this book value part right here as well. I want to cover this part. Okay, so now on the work together on page 541. Yeah, 541. The first one is on January 3rd, we bought a computer monitor costing $560, the estimated salvage value of $60, and a useful life of 5. Okay, so when you are filling this out, the plant asset, you bought a computer monitor. The depreciation method that we are using right now is straight line. In the transaction said that you bought the computer monitor for $560. The estimated salvage value was $60. You're planning on having it for 5 years. Okay, this is when you bought it. It was January 3rd. Okay, so the start of the year, beginning book value is $560. That's how much we bought it for. That's your original cost. That's your $560. To figure out our annual depreciation right there, that 100, all you have to do is take your $560, which is your original cost, minus your $60, which is your estimated salvage value. $560 minus $60 equals $500. Now we want to take that $500, divide that by 5, because that's how long you are planning on having it. So $500 divided by 5 equals your $100. Okay, so this is where that $100 comes into play, because per year, each year, this computer monitor will depreciate $100. Accumulated depreciation, so far you've only had $100 accumulate, so that's why that's 100 right there. Our ending book value. To determine our ending book value, all you have to do is take your original cost minus your accumulated depreciation. Okay, that gets your book value. So if you look on back at this example, you take your beginning book value of $560 minus your accumulated depreciation, which is your 100, that equals your $460. Okay, so now that's after the first 12 months of owning this computer monitor. We still have 4 more years to calculate. Okay, so now for the following year, we now after 1 year of having this computer monitor, it's valued at $460 because it depreciated $100. So at the beginning of year 2, you now have $460 computer monitor. You have it for the full year again because You have it for 5 years. We're only in year 2. So now that's why that's 100 again, because it's going to depreciate $100. Your accumulated depreciation, you take your accumulated depreciation number right here, plus how much it depreciated that current year. So 100 plus 100 equals your 200. Okay, so this is how you find that. Take your accumulated depreciation from the previous year, add your depreciation from this current year, and that equals your 200. Now your ending book value. Okay, ending book value, all you have to do is take your 460 minus your 100, that equals your 360 again. Okay, because you started here at 460, year 2 it depreciated $100. That is your 360. Now bring that 360 back down, because now we're starting year 3. We have 5 years, we're only on starting year 3. So now your computer monitor is valued at $360. It accumulated, or it depreciated $100 again. Now bring that 200 plus your 100. That's where that 300 comes into play. Now your ending book value, your 300. It started the year January 1st at 360. It depreciated a total of $100. That's where that 260 comes into play. Now bring that 260 on down. Again, you're in year 4, so that's why it's still 100. You're going to go the full 12 months. Accumulated depreciation, you have your 300 plus your 100 equals your 400. And then your 260 minus your 100 equals your 160 right there. Now bring that 160 down, because now we are starting year 5. And this is our last year that we are anticipating it to be good, or that we'll have it. So we have 160. At the start of year 5, we were anticipating our computer monitor to be valued at $160. It depreciates for that full year, because we have it for 5 full years. So that full year it depreciates another $100. Accumulated depreciation, you take your 400 plus your 100, and that equals your 500. All you have to do is take your 100, or your 160 minus your 100 equals your 60. Okay, so now at the end, when you are ready to get rid of it, it's still valued at $60. Okay, if I scroll up a little bit, if you add these two numbers together, your 500, because that's how much it depreciated while you owned it. 500 plus is how much it's still valued at. So 500 plus 60, if you look back right back there, it's going to add up to your original cost. Okay, so this is how you calculate if it's for the full X amount of years. On the second part, and I'm running out of time right now, so I'm going to start a new video to show you guys this one. Okay, but we're doing the same one, but look when you bought this one. You bought it in the middle of a year, and it's only good for 4 years. Okay, so now we have to go and calculate how much depreciation for November, December. But then that year that we get rid of it, which is in this last year, we have to look at, well, we sold it at the end of October. Obviously, we don't have it November, December, so we have to go back and figure out how much it depreciated for 10 months instead of 12. Okay, but I will show you guys this in the next video. If you guys do have any other questions relating to this, please obviously let me know. Reach out to me. Going back to our goal, what I just covered is we are looking at how to depreciate using a straight line method. Okay, this can play in your ordinary life of selling a car, selling a desk, okay, figuring out how much you bought it for, how many years you have it, how much it's going to depreciate over time. Okay, a car in particular would be a good real life experience for this. Okay, if you have any questions, reach out to me. I appreciate it. We will get through this. Talk to you next time.